This video is going to talk about impairments of value. These are reductions in value that are considered to be non-temporary for fixed assets or property, plant, and equipment, intangible assets, and goodwill. Three separate areas here. Good news is there's a lot of similarity. So when there's an impairment and we don't believe we're going to recover the lost value in the near future, then we have to recognize a loss on impairment. This is consistent with the conservatism concept in accounting. Recognize and give them the bad news when you know about it. Okay? So let's take a look at property, plant, and equipment first, and then we'll look at the other areas. The accounting provided by FASB, the new standards, whatever you want to call them, provides a variety of examples of when market value drops for an asset, whether it's due to new regulations or environmental changes of some sort or industry-specific activity, technology, whatever it may be. When there's a drop in value, we have to recognize it. So I'll let you look at these on your own. You shouldn't have to memorize them, certainly not for my classes. With property, plant, and equipment, we have to go through a two-step process. Okay, first we do what's called a recoverability test, and if that test fails, then we go to the second test, which is to determine the value of the impairment. So in step one, the recoverability test, what we do is we estimate the cash flows that this asset will generate for the remainder of its useful life, and we're going to compare those cash flows undiscounted. We don't discount them back to their present value. We're going to compare the undiscounted cash flows to the current book value, which you may recall is cost minus accumulated depreciation. If the fair value of the undiscounted cash flows is greater than the book value, then we don't have an impairment and we're done. In the other case, if the fair value of undiscounted cash flows is less than book value, we do have an impairment, and then to determine the value of the impairment, we have to go to step two. So let's take a look at an example to illustrate this. Okay, due to increased regulation of air quality, the current equipment of ABC Company can no longer pass emissions tests and will have to be replaced in 5 years instead of 8 years. Okay, so there's an impairment of value there, and most likely the salvage value will be measurably less because of its inability to pass these tests, and no one's going to buy it from us. Or if they do, it's going to be at a discounted price. So the asset has a current book value of $400,000, and the company expects cash flows for the next 5 years to be $90,000 per year. So if we multiply $90,000 times 5 years, and we're not discounting back to its present value, then we can see that the cash flows will be $450,000, which is greater than the book value of $400,000, and we don't have an impairment, and we're done. That's nice. Okay, but that's not why we're here. So if the cash flows, instead of being $90,000, were $75,000, and you multiply $75,000 times 5, that comes to $375,000, which is less than the book value, and we do have an impairment. That was step one. Now, why don't we discount the cash flows? That's a very good question. Sometimes pressure from industry on the accounting profession can result in compromises, and this may very well have been the case. I don't have a clear answer for you on that one, but that's currently what we do. So now, the undiscounted cash flows were less than book value. There can be no arguing. There's an impairment. To determine the impairment, we now take the fair value of this asset compared to the book value. With some assets, fair value can be determined through independent third-party appraisal. For example, Kelley Blue Book on vehicles. In other cases, it's more difficult to determine that, in which case we would take the cash flows and we would now discount them back to their present value, which is what we do in many other areas of accounting. Okay, so the undiscounted cash flows sounds like a concession that the accounting profession made to industry, and they said if you can't pass that test, you clearly have an impairment. And so now we're going to compare book value to the fair value, which when we don't have a third-party source for fair value, we will discount the cash flows back to their present value using the company's borrowing rate or their risk-free adjusted rate, whatever it may be. That would be provided to you. In this example, it's going to be 8%. Now, for this example, we're going to assume that cash flows take place at the end of the time period, which we would call an ordinary annuity. If you had an example where the cash flows were made at the beginning of the time period, that would be the annuity due. So we go to the appropriate present value table, which in this example is present value of an ordinary annuity. The number of time periods, n equals 5. The interest rate is 8. And our present value ordinary annuity factor is 3.99271. We multiply that times the $75,000 annual cash flows, and the present value, which we're using as fair value for this asset, is just under $300,000. We compare that to the book value, and we have about a $100,000 loss, slightly more. The journal entry, very straightforward. Debit, loss, and impairment, that hits the income statement. You would report that loss below the operating activities section on the income statement, and you credit accumulated depreciation to bring the book value down to its new book value, which is the fair value. There is another journal entry that you could use that you might see in a textbook, which is a little more complicated than this, not that big a deal, but they both accomplish the exact same thing, and that is they reduce the book value down from $400,000 down to $299,453. And that becomes your new book value going forward. Notice that at the very bottom it says U.S. GAAP does not allow us to recover any impairment losses if, for some reason in the future, the fair value of this asset were to increase. Okay? And notice that IFRS, International Financial Reporting Standards, does allow the restoration of an impairment up to the amount of the loss to get you back to the original book value. You can never go above that. Okay? So now, that was property, plant, and equipment. The good news, for intangible assets, it's pretty much the exact same process. However, we draw a distinction between those intangible assets that have a finite life, such as patents and copyrights, and those intangible assets that have an indefinite life, such as trademarks, trade names, and goodwill. So a patent has a 20-year legal life. A copyright is the life of the author plus 70 years. That's defined. That's a finite life. We use the exact same process, the two-step process with the recoverability test for intangible assets with a finite life, patents and copyrights. Same exact process. If the intangible asset, the trademark or goodwill, has an indefinite life, then we only use the fair value test, which is step 2. We skip the recoverability test. And if you think about it, if a trademark can be renewed every 10 years, then our cash flows are potentially endless. So it would never fail the recoverability test. So it's an inappropriate test under those circumstances. So we simply go to step 2 and we use the fair value test. We compare the fair value to the book value, and the difference, assuming fair value is less, that would be the amount of the impairment. Okay, so pretty straightforward. Goodwill is unique and the loss is measured a little bit differently. So let's take a look at that now. Okay, so let's recall that goodwill is the result of when Company A has purchased Company B. The purchase price, the acquisition price for Company B, is compared to the fair value of the net assets. Net assets is assets minus liabilities. Okay, so we compare the fair value, not book value. We step up the book value of the acquired company to its fair value. Net assets, which is assets minus liabilities, compare that to the purchase price. If the purchase price is greater than the fair value of net assets, that's the amount of goodwill that we're going to record on the books when we record the acquisition. We used to amortize goodwill many years ago, and then we stopped. We said, well, we're not even sure what we're amortizing. How did they pick 40 years or then 20 years? And they finally said, we're not going to amortize goodwill. However, we have to test for impairment at least annually. And so that's what they do here. So when you have reason to believe that there's been an impairment to the value of the acquired company and it's goodwill, then we have to test for impairment. And so first we compare the fair value of company B. We call that the reporting unit. A reporting unit, also called a segment, has to be considered a segment by the parent company. They measure their performance. They have an income statement. They measure the value of their assets and cash flows independently. Okay, so for example, General Electric owns GE jet engines. And GE jet engines is a reporting unit for General Electric because they treat it like pretty much a separate company. It does get consolidated into GE's financial statements, but it's a reporting unit for GE. Okay, so it has to be considered a reporting unit by the parent company. We compare the fair value. If we were to sell that reporting unit, what's the fair value? We compare that to the current book value. And if the fair value is less than the book value, then we have an impairment. And in order to determine the value of the impairment of goodwill, we have to calculate something called the implied fair value of goodwill. So let's take a look at that. Okay, so ABC company purchased XYZ several years ago for $1.8 million. The net assets of B are as follows. Assets minus liabilities equals $2,250,000. XYZ was unable to defend an important patent, resulted in a reduction in value. The fair value is believed to be $2,500,000. $2,500,000 fair value is greater than the book value of net assets, $2,250,000. There's no impairment. We're done. If instead the fair value were $2 million, not $2,500,000, but $2 million, that's going to be less than the book value of $2,250,000. So we do have an impairment. And now we have to calculate the implied fair value of goodwill. And the way that we do that is we're going to calculate on an itemized basis, asset by asset, the fair value of all the assets and the fair value of the liabilities, which again gets us to net assets, excluding goodwill. So what's the fair value of all the assets and liabilities on the balance sheet, excluding goodwill, and we come up with a dollar value. We compare that dollar value, the fair value of net assets, excluding goodwill, compare that to the fair value of the reporting unit if we were to sell the reporting unit, that segment or that subsidiary by itself. The difference between the fair value of the reporting unit and the fair value of the net assets would be what's called the implied goodwill. Sounds reasonable? Here's what we can sell the unit for. Here's the fair value of all the net assets. The difference, goodwill. We compare that implied goodwill to the original book value of the goodwill when we acquired that reporting unit. So in our example, the goodwill is $800,000. The fair value, if we were to sell the unit, is $2 million. And the fair value of net assets, excluding goodwill, is $1.5 million. Okay? How do we come up with that? Well, we had to do an analysis, time-consuming, costly, etc. And so the implied fair value is $500,000, right? $2 million minus $1.5 million is $500,000. Our original book value is $800,000, which indicates a loss, an impairment of the goodwill of $300,000. And that's going to be the journal entry that we record. We simply debit loss on impairment and we credit goodwill, and that brings the goodwill down to its new implied fair value. Okay? So that's how you calculate the impairment on goodwill. Now, as of the date of this recording, we are in the middle of an implementation phase. So I need to talk about that. There must have been enough pushback from industry on this process of calculating the fair value of net assets that the accounting profession has said, okay, let's simplify the process and we're going to eliminate step 2 of this process of calculating implied fair value. So we're simply going to look at the fair value of the reporting unit to the book value of the reporting unit, which was step 1, and that difference, assuming fair value is less, that would be the amount of the impairment. We're going to skip step 2, calculating the implied fair value. Now let's take a look at the slide together. Notice it says publicly traded companies. will begin implementing these changes at the end of 2019, and private companies and not-for-profit will do so at the end of 2021. This new ruling or new accounting standard was issued in early 2017, and they allow for early implementation. So what I would suggest you do is you talk to your teacher, depending on when you watch this video, and ask them which treatment are they going to test you on. If you're taking the CPA exam, I would imagine they're going to test the new standard where we skip step 2 and that we just simply compare fair value to book value as if they had already gone for the early implementation. But they will provide, hopefully they'll provide guidance on that. If they don't, most likely, since that's the direction we're going in, I would, if I were you on the CPA exam, I would assume that they're implementing this on the exam. That's it.